Hi, welcome to this Screencastify podcast where we're going to be looking at the general journal. The general journal is the final journal we're going to be looking at if you're doing my IGCSE course, and it's basically the everything else prime entry or journal. So it's all the transactions that don't go in either the cash book, the petty cash book, sales journal, sales returns journal, purchases journal, or purchases returns journal. Just going to have a look at some of the entries that go in there in this podcast, and then there'll be two more. One looking at errors that do affect the trial balance, and the second one, errors that don't affect the trial balance. Okay, first thing, quite a basic one that goes in. We always make a journal entry for the first entry of the business. So in this case here, we're starting a business. They're going to be $5,000 going into the bank, $500 is cash. The owner's introduced a vehicle that's valued at $4,000. He's also taken out a bank loan of $5,000, and the rest of it is actually being introduced by the owner, so it will go in as capital. And in theory, what the business would do is it would make those entries into a journal before it posts them into these ledger accounts. So let's have a look at what would get put into the journal. Okay, so the way that the journal works, it tells somebody else how they are going to post things actually in the ledger accounts. So here what we can see is that on the 1st of April, which is when the business starts, there's $5,000 going to go into the bank, $500 into cash, $4,000 in the vehicles account, and on the credit side, somebody needs to go and make a $5,000 posting on the credit side of a loan account. And in the capital account, they need to go and post $4,000 and $500 as the cash entry. The final thing that you'll always see in a journal entry is some kind of commentary telling people why the entry is being made. Because these are unusual entries, it helps with the audit trail. It allows people to see why the accountant has made these decisions about where he's going to post things. So here the commentary is quite simple: introduction of capital and a loan to start the business. The next thing that we always use the journal for are those end of year balancing of income and expense accounts where they go into the income statement. So here we've got the sales. Okay, the sales total $4,000 for the year. So therefore, what we already know how to do is when we balance off that account at the end of the year, the balancing figure is going to appear in the income statement, and it will be a credit entry in the income statement because we're balancing off on the debit side of the sales account. So what one of the main accountants would do, he would write that up in the journal. So we're going to debit the sales account for $4,000, and therefore we need to have a credit entry in the income statement of $4,000. And again, commentary, pretty straightforward. Transfer of, I don't know why I said wages, although it could have been wages, but sales to the income statement. Drawings, we talked about this before, but very quickly what we would do with the drawings account is very slightly different to the normal income and expenses accounts at the end of the year, because the drawings actually get transferred into the capital account. So again, what we should already know how to do is actually do the ledger entry. So in the ledger, we balance off the drawings account at the end of the year, and we would put a debit entry into capital. Okay, and what would get written up in the journal is that we need to debit the capital entry, the capital account, which we have done, and we need to put a credit entry in the drawings account, which we have done, and commentary pretty straightforward. Transfer of drawings to the capital account. Okay, so questions there for you to have a go at, and then after that we'll just do it because there's a quick 2 or 3 minutes left on the video. In the video, I'm going to also go on to consider entries of non-current assets. Non-current assets, okay. Purchase or sale of non-current assets on credit and only on credit appears in the journal. The reason why cash or bank purchases of non-current assets don't appear in the journal is because they would appear in the cash book, and it's only the purchase of non-current assets or sale of non-current assets that appear in the journal because straightforward purchase of goods for resale or where we are selling goods, those entries already appear, we already know they appear in the sales journal or the purchases journal. So here, John Davis purchased a vehicle from Iffy Cars for $10,000 on the 27th of the 2nd, 2016. Well, hopefully what we already know is that because we've purchased a non-current asset, we need to tell somebody to go and make a debit entry in the vehicles account. So if we look across here at the vehicles account, once it's been entered into the journal, somebody will go into the general ledger and put a debit entry in for the vehicle. And then, because they're buying it on credit, they are going to owe Iffy Cars some money. So we need to put a credit entry in against Iffy Cars because they are now a liability. Okay, and then a commentary. The commentary for this is going to be straightforward because it's just the purchase of motor vehicles on credit. Okay, the sort of opposite of that would be where we sell a non-current asset on credit. So here, a bit later in the year, they've decided to sell a delivery vehicle that they own. So John Davis is going to sell it to F&L Cakes. And he's going to sell it for $5,000. So the first thing is F&L Cakes are going to be a debit entry. They're going to be a debit entry because F&L Cakes now owe the business some money. So if we look now at F&L Cakes' account, we've now got them in there as being an asset. They owe the business $5,000. And the credit entry, well, technically, the credit entry should actually go into a disposal account, but some of you won't have done that yet. So at the moment here, you could also put it down the moment if you haven't done disposal accounts, it's the vehicles account, and we're going to put a credit entry in there for the $5,000. So in the disposal account, $5,000 goes on the credit side because we've lost an added asset. And the commentary, pretty straightforward, just the sale of a vehicle on credit. Quick recap on what you need to remember. The first thing on the journal entries or the general journal entries, we're going to have the date of the transaction. Quite often you'll only see the date written once because obviously the debit and credit entry both relate to the same transaction. The standard thing that we normally try to do is put the debit entry first and the credit entry second. Although in an exam, if you've made a mistake, don't be afraid just to put the debit entry under the credit entry. And we're also going to always write a commentary. Occasionally in an exam question, you'll see it where it does say commentary not required, and obviously then you don't need to write a commentary. But as a standard, or if you see nothing in an exam question, put in a brief commentary explaining what the transaction is all about. Again, a few more questions for you guys to have a go at. Once you finish these questions, obviously share it with me so I can mark it, and good luck with the questions.